They say you're the sum of the company you keep. 5 friends define you, their wisdom you reap. Well, I looked around at the brains in my crew, they're smarter than me. Thank God it's true. I don't need the answers on my own. Their wisdom lifts me, I'm not alone. I got itty bitty baby hands and an itty bitty baby brain, but I love smart people, they sharpen my game. Everyone's got something, and I'll bring mine. We're greater than the sum when we combine. I married a genius, the class valedictorian. Brains and beauty in one, I hit euphoria. She does the numbers while I crack the jokes. I'm carried by brilliance wherever we go. I don't need the answers on my own. Their wisdom lifts me, I'm not alone. I got itty bitty baby hands and an itty bitty baby brain, but I love smart people, they sharpen my game. Everyone's got something, and I bring mine. We're greater than the sum when we combine. Brains and wit, they light the spark. I'll bring the laughter, they'll bring the charts. Together we shine, together we grow. I'm proof you don't need to be Einstein to know. I got itty bitty baby hands and an itty bitty baby brain, but I love smart people, they sharpen my game. Everyone's got something, and I bring mine. We're greater than the sum when we combine. Together we shine, together we grow. I'm proof you don't need to be Einstein to know. I got itty bitty baby hands and an itty bitty baby brain, but I love smart people, they sharpen my game. Everyone's got something, and I bring mine. We're greater than the sum when we combine. Greater, 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 greater. We're greater than the sum when we combine. Hey!
Good morning, Outliers. Today is Ask Me Anything Friday. It's also Fun Shirt Friday. I'm here for you in any way possible. What I'd like you to do is put hashtag Q with your question in the chat, and I will begin answering those as soon as they roll in. Now, I don't want to get cranky. I really don't want to get cranky. But if you guys come at me today saying, oh, the outlier signals are the worst. Nah, Chris, I can't believe you made me sell my SoFi shares. Meh, we're going to shut this down early. Okay? I'm just telling you. I've already seen the Discord messages about how everybody can't believe the fact that they don't have 100% win rate. And I'm already wound up. Because this is the plan ETF backtested historical results. Notice, it does not have big winner or big losers. It has very big winners. It has huge winners. This is a 3, a 3.5, and a 5 standard deviation winner. Just like the example we showed in Bravo class yesterday. And yeah, it does have losers. Plenty of them. That's part of the game. Building losers into the plan is paramount. If you don't build losers into the plan, you will not be successful because you will not know what to do when you have the losers in the plan. So get off your high horse. Stop acting like this is all Chris's fault. All right. Listen, like I said, I'm already worked up about this. And if y'all come at me today, it's going to be a really short video. I don't want it to be that. I want to help you as much as I possibly can. Now, a couple things is that we need to start prepping for Thanksgiving. During that week, I want to do lots of replays. So I'm going to set a 30-minute timer for these questions. So whatever questions you have, start throw them in there. Throw them in there real quick. I will go through as many as I can in that 30-minute time frame. And then we're going to start a second video, which somebody posted this. I believe it was Kostya in the OVTLYR U chat about, I think it was in here. Yeah, it was Kostya. A great and very appropriate video for us. Now, this is, we're going to watch this in a bit from the Veritasium channel. It's a great channel. The most dangerous cognitive bias, which as traders, we can be very guilty of cognitive bias. And so that's one of the things we as traders have to work on is getting around these cognitive biases. Rick says there's a new song that's nearly finished. Very exciting. All right. Where can you buy a shirt like this? Well, this came from Academy, but Academy Sports and Outdoors. You can probably order it online. I can't tell you if it does or doesn't. This came from Good Gravy. I don't know when I bought it. The last time I wore it, though, was when we went to Lukenbach over the summer. For those of you who don't know, this summer we were in, or was it summer? Yeah, it was summer. We were in the area of Texas. I got hit by that flood and hundreds of people died. We were 20 minutes from there. That just is crazy how close we came to that. Yeah, that was unbelievable. That was the last time I wore this shirt. Hopefully we don't get flooded. Nate has a great question. Senior Wahoo. I love this question. How did soccer season go? And did you enjoy coaching? So last night was our final practice. Saturday is our second to last game, but I won't be there because we're going to the Cub Scout camp out. So I'm camping tonight and tomorrow night, coming back on Sunday with my son. My wife, who's bougie AF, this is her very first camping trip, which I'm excited about. So we're going to miss that game. But then our final game is on Monday night. And I got to tell you, man, the fulfillment that comes from watching the players grow is so cool, right? So cool. And I didn't, as a parent, I could always, cheer on my son, but I didn't see the growth of their skills until becoming one of their coaches. So it's pretty cool. Great question from RG. I'm going to hold on to it. Is the current trade a good trade or bad trade? This is a great question. I love it. Is there any truth in making money within the money covered calls? We can examine that. I think in the money covered calls is stupid, but that's just me. Explain the difference in the orange and blue bands in the OVTLYR charts. Okay. Smile, Chris. Well, I love you. Oh, thanks, Richard. Oh, no, not everybody loves me. Half of y'all think that I'm obviously an idiot. Chris, I love this channel. I've learned so much. My questions, see how buying calls, how the signals align. Going with trend, do you ever buy puts? Okay, we're going to hold on to that one. I like it. Oh, hang on. Oh, Kenny, I just dropped that question off. My bad. Rudes, can you find this question from Kenny and restart it again? I unstart it. Rude's my editor. She's our channel manager, and she's helping me with moderation. Which of the 5 market wizards impacted the most? Well, that's an easy question. We'll come to that in a minute. Heard you say you do not use a stop loss on an option. Okay, it's a good question. I'll hang on to that. Nate, is there some educational setup that explains everything? Oh, I love it. Good question, Nate. I love a softball. Do you always trade at the end of the day? Yes, we'll answer that. We'll talk in a little bit. What is your opinion between buy, call, and a short ETF or buy a put on the normal ETF? Okay, I'll work on that. Is there... I love it, Nate. That's great. Can you talk about the stock close, price effect, your moving average? Okay, we're going to work on that. You'd account for tax purposes. Okay, it's a good question, but I'm not an accountant, so I'm not going to give you any advice on that, but I'll try and answer as best I can. How to roll and put options. Okay. Mike, can you elaborate on the bell charts, please? Oh, yeah, for sure. The bell curve. I got you. We paused before to reevaluate our trading plan. How long does the trading plan go with a loss? But bro, we've had Justin. I love you. We've had 3 trades on plan ETF. This is what I'm talking about. If you guys want to push me, I'm going to push right back. We've had 3 trades on Plan ETF. One was a winner. One was a loser and basically offset the other one. This one is going to be a little bit bigger of a loser, and it's going to fall somewhere over here. So we had one here, and one here. Don't come at me saying we need to review the entire thing. When utilizing the position sizing spreadsheet, how do we get the entire 100,000 portfolio working for us? Position sizing is not soon enough. That's on purpose. That's on purpose. We'll come back to that, Doug. I like it. Christopher Walken. This has to be the actual Christopher Walken. It can't be anybody else. Academy.com, I believe, is the website. But anyway, Academy Sports and Outdoors in Texas. I don't know if they probably they don't sell it in other places as well. Okay, lots of good questions coming through. And we'll talk about that in all a minute. Thank you so much. Everybody, I'm super glad you're here. I'll do my very best to answer everything that I possibly can. So I'm going to start the timer in just a minute, and I'm going to start with Nate's question right here because I think it's a brilliant one. And it really plays on... Oh, hang on. I was just looking at something Scott sent me. Okay, here we go. Plan M backtesting data. Okay, so we're going to start here with Nate, but I have to hit the hook. I have to hit the hook. All right. I got to start with a chart. I'm going to talk about SoFi. I don't want your account to look like SoFi did yesterday. Down nearly 12%. This stock is getting absolutely monkey hammered here. And because of that, I don't want this to happen to you. We are doing what I like to call Ask Me Anything Friday. Now, I have a huge list of questions from our viewers, and I'm going to answer them live and try and give you the very best responses that I possibly can to help you save time, make money, and start winning with less risk. Nate asks the question, is the new half ATR roll-up rule from Scott Raff and back-tested, or did it come from somewhere else? So Scott Raff was our intern over the summer, our quant intern. And on the Plan M, this is a new rule that I put in place just the other day. And in fact, I believe it was maybe a week ago today. So Plan M, the average trade days was 17 days. And over 7,000 trades, this has a 57% win rate, with the average trade return being 2.25%. Keep in mind, this is building losses into the plan. This builds losses into the plan. If you can't build losses into the plan, you don't have a plan. You have a hope and a dream. So losses are built into the plan 43% of the time. Yet the total on all trades combined was a 2.25% average gain. So to Nate's question, the half ATR roll up, when we do Plan M, which we haven't done Plan M yet, right? We've only been in Plan ETF 3 times so far. The rest of the time we've been sitting in cash, not effing up our portfolios. The first half ATR gets a roll. The way that came from, Nate, was looking here. The winners on Plan ETF had an average up move of 3 ATRs from the beginning of the trade to the highest peak of the trade, an average up move of 3 ATRs, with the average end being somewhere around 2.2. The losers had an average up move of 0.6. And then the average net result was down 1.38 ATRs. Now, when I was reading through this the other day, I was like, wait a minute here. At this first half ATR up in a trade, so imagine we buy SoFi here, and it goes up half an ATR. Okay, this is not advice. I'm just telling you, this is as an example. Let's say that we opened it here, and the current ATR value is 2.09. So if it goes up $1, that would be a half ATR. And so that would be 28.37, so 29.37 here. Okay, so imagine it goes up half of an ATR. That would be our first rolling point. Now, I want you to remember, at this point in the trade, we don't know if this is going to be a winning trade or a losing trade. This is still up in the air. We don't know. Okay. And because of that, we can't say, well, it's handicapping one and not the other. No. It is a defensive position because when we roll, we're taking partial profits. We're keeping the trade alive and we're freeing up capital that we can trade with something else. Because we don't know at the time of the first ATR getting hit if it will be a winner or loser, we are therefore helping both sides, both a winner or a loser, by taking cash off the table. So I think it's really cool. I think it's going to be a huge help for us as we work through these trading plans. RG 2312 says, how do you take IV into account with the spread and options? Well, first, I don't do any spreads and options. I only trade long calls. And honestly, I don't know the next time I'll trade long puts. So I only trade long calls. Now, we're going to look at SoFi here just because it's pulled up. The implied volatility is going to change from week to week, day to day, stock to stock. The implied volatility is going to change. Implied volatility is basically it goes into the extrinsic value. Okay. Implied volatility goes into the extrinsic value. That is fallen into the Greek known as vega. Intrinsic value is the calculation between the current price and the strike price. So that will only be mathed out between the current price and the strike price will be intrinsic value. Extrinsic includes time value and vega, which is the implied volatility. And that implied volatility is basically building in more uncertainty because remember, the extrinsic value is additional uncertainty. The closer you get to expiration, the closer that gets to zero. The further you get from expiration, the more extrinsic value you will always pay every time, no matter what, because that's how options work. So looking at the extrinsic value here, that will inflate or deflate partially from vega, implied volatility, and partially from theta. And theta will decrease over time. Vega can expand or contract at the same time. So to RG's question here, how do you take it into consideration? I don't. Now you're probably like, wait, what? What do you mean you don't? I don't, right? When I'm looking on an options chain, I basically look for the 80 delta, and then I look at what percent of the extrinsic value is of the total cost. Now, this is super wide. Let's go to something more liquid. Maybe AMD is more liquid. I don't know. Let's see. Hold tight. Let it load in. There we go. Yeah, this is tighter. So I basically start at the 80 delta. And then I take the percentage of extrinsic value, 447 over 3280. 3280 is the ask price. That's what you're going to buy it for. And so 447 extrinsic value divided by 3280 gets me 13%. 13% of my option is extrinsic value. Now, if implied volatility has expanded and this is bigger, and I look at this and this comes out to like 33%, it's not that difficult. All you have to do is go deeper in the money. Because the deeper you go in the money, the less extrinsic value you're paying. So therefore, the less total percentage will decay. And that is part of my trading plan. Right. Where is that at? Here. 30% is my absolute max on extrinsic value. My goal is hitting 20% or less, but absolutely no more than 30%. And because that is the uncertainty value that will decay over time. So you've probably, and based on this question, you've probably watched videos talking about how you need to sell options when implied volatility is high and buy options when implied volatility is low. The way that I trade, the way that outliers trade, is it doesn't matter. Oh, wait, I get to do it. Hold on. I get to do it. Hold tight. This is a gag that I'm going to start doing, right? The way that I look at it, crap, hang on, I'm blowing it, but I'm still going to do it. The way that I trade is like this.
That's exactly. It doesn't matter what you think.
It doesn't matter how much extrinsic value there is, as long as it's under 30%, right? It doesn't matter how much the implied volatility is, because I'm going to account for it. Outliers are going to account for it. And it's as easy as moving up the street. So it's a great question, honestly. I don't fault you for that question. But in reality, if all I'm doing is trying to base my trades on keeping as low extrinsic value as possible, and all I have to do is just move up the options chain, makes it super simple. Now, Rick has a great question. This is a brilliant question from Rick. Is the current trade a good trade or a bad trade? So for those of you who don't know, We are in plan ETF right now, and I we're talking about this in Bravo class yesterday. Part of being a trader is understanding the acceptance of risk, right? When I put the trade on, I was accepting the fact that I had risk in the trade. Remember, all stocks are bad, but every once in a while they act right. So for this trade that I put on, right, I knew what I was getting into, and all I had to do was create a plan and therefore follow the plan. And right, it went down. Could I have done anything about this? Is there anything at all that Chris could have done to have prevented this? Until I get Nancy Pelosi's phone number, there's nothing, not a single thing that I could have done to prevent this. And I don't have to, because I accept the risk that comes along with trading stocks. If you can't accept the risk of any stock turning around, you should not be trading. So to Rick's question here, is it a good trade or a bad trade? And we discussed this yesterday in OVTLYR, right? You're probably thinking, or in OVTLYR Universe, you're probably thinking, well, clearly it's a bad trade, Chris. Absolutely not. Absolutely not. This is a good trade. And the reason that it's a good trade is because I had a plan to get in, I have a plan to get out, and I have no expectation on what the outcome will be between those 2 points. When you stop having the expectation of an outcome and you just follow your plan, the profits will automatically take care of themselves. But Chris, this trade isn't profitable. I understand. And we have built losses into the plan. And you need to, and Rick, I'm not speaking to you personally, I'm talking to those who are complaining. You've got to understand that even the very best traders in the world, this is from Mark Minervini, even the very best traders in the world have a skewed bell curve. And Mike, this is to answer your question too, have a skewed bell curve where the normal distribution is not normal. That is very similar to plan ETF right here, right? This is the higher this goes, the higher the frequency, right? So we can see we had some big winners, big giant winners, and then we had plenty of good-sized winners. I call this moderate winners. We had lots of break-evens to small losers, and that's it. Now, there are 4 types of trades: good trades, bad trades, winning trades, and losing trades. Good trades are trades that you can win on and lose on. A bad trade is one that you didn't have a plan and you just YOLO'd into it. You FOMO'd into it, right? I, as a fund manager, have a plan. And I get so frustrated, Rick, and it's not at you directly, but I get so frustrated because it's like these people expect me to deliver them trades that only go up. But Chris, you're a fund manager. Shouldn't you always have a 100% win rate? No. In fact, all of my data shows that that is an impossibility. But what this shows is the 4 types of outcomes that are 100% possible in every single trade, which is a big win over here, a small win over here, break even right here, and a small loss right here. Notice there are no big losses. So I don't understand why everybody is crying their faces off when this is part of the plan. Nothing has changed. Everything is following the plan exactly. But Rick, to your point, it's a great trade because I'm going to follow my plan. Is there any truth to making money with in the money covered calls? Now that's a weird thing. Now, Thomas, I don't know if this is a trade you make or not, but in the money covered calls are very weird to me. So let's do a covered call because I want to describe what a covered call is, right? First, you own the shares of stock. Open image, new tab. First, you own the shares of stock. Well, this is a big image today. You own the shares of stock, so it moves like this. You sell calls against that stock, so therefore you cap your gains. If you're doing an in-the-money covered call, that feels broken. Because first off, let's say you own the shares and you're selling an in-the-money covered call, so you're only going to take advantage of the extrinsic value. The extrinsic value is the only thing you will make money on if you sell a call, period. A covered call only makes money on the extrinsic value. So why sell it in the money? That feels like you've handicapped yourself. Like you've taken your trade out at the knees. I don't understand why anybody would do that. And then there's additional risk to that. I know this sounds crazy, but there is actually additional risk to go along with this. Because with the covered call, let's say that you're in AMD and you sell the 280s, okay? You're selling the 280 calls for $4. You actually get the capital appreciation from 250 to 280. You get all of that juicy goodness. You get all of this move, this $30 move right here. You get all of that. And if it doesn't go over 280, you get all of that plus the $4. Even if it does go over 280, you get all of that plus the $4 you sold it for. But if you're doing in the money, you get no capital appreciation. You only get the extrinsic value. That's weird to me. I don't know why anybody would do this. But you know what? You do you. If that's your trading plan, I'm not going to tell you what it is. Explain the difference between the orange and blue bands. That's not a very polite way to ask, my friend. Explain the difference, Bruce. How dare you? How dare you give me something to do like that? I'm going to pop one open at random. So the orange and blue bands that he's talking about right here, these are order blocks built inside of OVTLYR. And that's what filters into the order blocks over here out of the OVTLYR 9. But looking at this, right, when I'm looking at these right here, I always want to confirm them on the trading view chart because sometimes OVTLYR will pick up some that trading view doesn't, and trading view picks up some that OVTLYR doesn't. I like to have that double confirmation, but that's all it is. That's the order blocks. Now, this is an area of resistance, overhead resistance right here. And you can see how it's fought through that area and has not been able to go through it and went down. And now it's created an area of support down here, which if it pulls back, it could help it with bouncing back up. These are areas of significant buying and selling activity. That's what it means. Jeff asks, which of the 5 market wizards that I worked with have you felt impacted you the most? So for those of you who don't know, who just think I'm a random guy on the internet, I've been trading for 16 years. I've made $4 in the market. And the market wizards, I've worked with 5 of them. They're the greatest traders of all time. There's Mark Minervini, Tom Basso, Larry Height, Jason Shapiro, and Jack Schwager. I would say the 2 that were the most impactful were obviously Mark Minervini and Larry Height. Those are the 2 that I talk about the most. Tom Basso, interestingly enough, was all about that trading psychology. Oh my gosh. His nickname is Mr. Serenity in trading. And if you want to know why I act the way that I do, it has a lot to do with the principles that I learned from Tom Basso, right? Larry Height, the things that he taught me were following the trends and, using options and the leverage that comes along with those. Amazing work from Larry. Mark, I can't even put a finger on all the things that I learned from Mark. And then Tom Basso, just honestly, all day, every day, that trading psychology, that laissez-faire, that flippant attitude to trading stocks of, I don't know what's going to happen. And I don't need to know what's going to happen. Because given enough trades, given enough data, this is how the back test performs. So therefore, the more opportunities I have, the more likely that this will happen. The more likely that this will happen. Which is actually a really cool thing to think about, right? Kevin says, I heard you say do not use a stop loss on an option. Is it safe for me to assume that in your plan you do not use a stop loss on plan ETF? And for my plan, I want to use one. If I want to use one, I can. So Kevin, first off, always come up with your own rules, right? All I do is share my rules, right? And my rules are not going to fit everybody's personality. And I don't expect them to fit everyone's personality. My rules were built in a way that fit my personality with the data, and I'm very comfortable with running it. Now, I don't use stops on options because option prices can widen out bigly without even trying. Something that's, in this case, 65 cents wide could widen out to $1.65 and then contract into 25 cents, then widen out to $2.35 at different points during the same trading session. It can widen out like that. And then if you get your stop loss associated with the price of the option, right? I know a lot of people like the idea of putting like a 30% stop loss on the option just in case. Imagine that it widens out and the bid is so low, it ticks your your stop out point. The stock didn't hardly do anything, but the options widened out. And now you're out of the trade for nothing. You just lost for nothing. That's happened to me, which is why I will never put a stop order on an option, period, full stop. It's not going to happen. I want to manually be in control of that. And I think you should be as well. But is it safe to say you don't use a stop loss on plan ETF? These are my exit signals on plan ETF. If it does not fit one of these things, then I don't worry about it. And that is the type of attitude you have to develop as a trader. Is these are my entry signals, these are my exit signals. If nothing is hit, then I don't do anything. I don't sit there and sweat and lose sleep at night because I have position sized myself in a way where it's going to be what it's going to be. And until one of these things is hit, I don't do anything. But if you are losing sleep at night, you're trading too big. A great question though, Kevin. Nate, is there some sort of educational setup that explains everything that us poor traders could use to save time, make money, and start winning with less risk? Well, Nate, I'm glad you asked because OVTLYR University is happening right now.
Are you ready? Let's go!
Respect is earned. Respect is never given.
That is right. Every Tuesday and Thursday afternoon, we have a full class of students who are learning in OVTLYR University, right? I'm teaching them literally everything that I possibly have learned in the 16 years of trading and the time that I've made $4 in the market and working with all the market wizards that I have, right? I've come across an incredible amount of information that I want to share with you. Now, if you are an outlier, it is included as part of the 82 cents a day. There is no additional cost to it, and it will be provided on YouTube as a replay for free, and it will live out on YouTube forever, right? I want you to be successful. Our job at OVTLYR is to make money with you, not make money from you. So other people would charge you $12,000 for something like this, and we give it to you 100% free as part of the OVTLYR package, which is literally just 82 cents a day. So great question. Really appreciate that. Lil even says, you always trade at the end of the day, except on emergency exits? Yeah, but that's my plan. That's my plan, right? These exit signals are all end of day exit signals because that's how the data was built. Ooh, wait, what? Wait, what? The data that built this plan right here was all built on end of day closing price signals. So therefore, I don't need to do anything but trade at the end of the day. Now, there is a modification in Plan M for a 3 ATR midday emergency exit. But the likelihood of that being hit is pretty low because the average trade exit is only 1.3 ATRs down. But when Scott and I were working on this plan and I looked at the biggest losers, I was like, all of them are greater than 3 ATRs. And there wasn't very many. There was only like 8 of the 7,000. I was like, I'm just going to put a 3 ATR max stop. And of course, that helped our overall results. So that is my only midday emergency exit. Rui asks, what is your opinion between the buy? Okay, let me see if I can read this correctly. What is your opinion between buy call on a short ETF or buy a put on the normal ETF? I got it. If the plan is to go short, of course. So if you were to buy a put, so let's use SPY, for example. If you were saying, okay, I think SPY is going to go down, so I'm going to take a bearish stance. So I'm going to buy a put on the SPY. Okay, that makes sense. Or if you were to go on a inverse ETF, buying a call because the inverse ETF would go up in value as the price of SPY would go down. I wouldn't overcomplicate it. Personally, I wouldn't overcomplicate it. If you're bearish on the thing, just buy a put. If you're bullish on the thing, I would just buy a call. Can you do either one? Yeah. And I mean, logically, what you're talking about makes sense, but I feel like it's adding a layer of complexity that you may not need. Stock Runner, can you talk about how the stock close price affects plans AM ETF plan analysis outside of the standard bullish setups. Examples 10 over 20 price or 50. A price hit or cross below 10 or 20, any exit triggers. I mean, I'm not 100% sure of the question here, so I'm just gonna show you the exit signals, right? And this is part of the thing with OVTLYR, right? We don't hold anything back at all. These are the plan exit signals. Now, of course, if you are trading something that doesn't fit plan M or plan A or plan ETF, that's fine, right? We still give you the sell signals. In fact, today we have 53 sell signals and 53 buys, or 56 sell signals, 53 buy signals. That's it. So plan M, a sell signal, a 10-20 bearish cross. If it runs into an OVTLYR block that's at least 120 calendar days old. If there's earnings, I will close before earnings. A gap and crap where it goes up 5% and then comes down. 2 ATR stop loss and a 3 ATR midday emergency exit, right? Plan A, similar but different. A close under, or I'm sorry, the sell signal and OVTLYR, a close under the 10 EMA, an OVTLYR block, earnings, or gap and crap. So there's a lot of crossover here. Plan ETF, sell signal, 10-20 bearish cross, an order block being hit, or close well above the 3 ATRs of the 20 EMA. I mean, these are actually significantly less, whatever plan you pick. And here's the other thing too, right? If you're going to trade a plan M, you have to follow the plan M entries and you have to follow the plan M exits. Or if you're gonna create the stock runner plan, you have to follow the stock runner entries and the stock runner exits. You're not allowed, and a lot of people do this, by the way. You're not allowed to say, okay, this is a planned stock runner entry. And then you turn around and you FOMO out of it, or you panic sell, and then you FOMO into something new. And then you're like, oh, wait a minute, I should follow that plan. No. The deal is that if you create a plan, if you backtest a plan, you got to follow the plan. Larry Height, one of the market wizards, like I talked about earlier, specifically, he and I talked about this, and I'll never forget this, because he said, if you have a plan and you don't follow that plan, you might as well just crumple it and throw it out the window because you never had a plan to start with. Janine says, do you have an account set up like a business LLC for tax purposes so you can write off all expenses? I do have an LLC that I trade through. I'm not giving you any sort of tax advice. I would seek out the advice of a professional accountant. That's as far as I'm going to go with that. How to roll put options. I'm confused. I haven't even rolled a call option. Well, rolling is super cool, right? Rolling is where you're able to take partial profits, keep the trade alive, and free up capital to make new trades. So if you were to roll a call option, we'll start there and then we'll go to the puts. To rolling a call option, let's say that you own the 200s and it's gone great on AMD and now you want to roll up. So what you would do is one order, you would sell to close the 200, then you would go closer to the money and you can decide where that is. I mean, I'm going to look for liquidity. I'm going to look for my extrinsic value. I'm going to look for the bid-ask spread. And if I find one that I like, that's going to be the one. And it could be $20. It could be $5. It could be $2. That part is up to you. And I would focus more on liquidity than anything. And then you need to make sure that you're getting a credit. If you're not taking in a credit, you've done it wrong. Now, let's say you need to go out, right? Let's say that you're on this expiration and you're like, oh, you know, I've got the 220s here, but this is going to expire today. I got to do something with it. You can roll out in time. But if you do, you need to make sure that you roll for a credit, because if you roll from the 220 to the 220, it will cost a debit. Why? Because you have greater extrinsic value, right? You have 16 cents of extrinsic value today, and you have $1.76 extrinsic value for 1 week out. The intrinsic value will be identical, because remember, the intrinsic value is the difference between the current price and the strike price. So if you do same between expirations, it will cost you a debit. Do not do that. That increases your risk. It actually costs you money, and it does not help you. It gives you more time, but then it also gives you higher risk. So what you would do is you would go to the 220, and then you'd have to roll closer to the money, maybe to the 225, to the 230. Let's just do the 225 for round numbers here. And that takes in a credit of around $3.12 at the mid price. Pretty cool, right? Now, let's do that on the puts. Let's say that you bought a put and it's going great. And let's say you own the 270 puts. And so to do this, you would sell to close the 270 put. and just do the same thing we did. You would go closer to the money. So from 270 maybe to like 260, and you buy that one. And you need to make sure that you're taking in a credit. In this case, I think I clicked it wrong. Hang on. Sell to close, buy to open. Should take in a. Oh, I am doing it backwards. So I was doing the call side. Sell to close, buy to open. There we go. And you're taking a credit of $7.93 in this case. So therefore, you reduce your risk by $7.93. So it's the same as you do on the call side, just flipped onto the puts. That's all. You got it. You got this. Let's see. Steven says, someone posted a video about using collars as a free or cheap way to protect your trades. What is your opinion about collars? It's been a minute since I don't even remember what a collar is. Let me go look at it real quick. If I remember correctly, and I could be wrong, it is selling a put and buying a call simultaneously. Basically synthetic long stock. Let's do collar option. I could be wrong. Let's double check that. Long put, short call. Yeah, for the stock. Yeah, for the short call. So you're selling it. So you own the stock. You're selling a call against it, and you're buying a put. Oh, I see. So what you've done is you've taken a trade that was just long stock, and then you've wrapped it into a put credit spread, or really you're crossing both sides. This is useless. I don't see any reason to do that. Yes, you're going to get some credit from selling the short call, but then you're going to pay a debit to get the long put. I don't understand how that would help you at all. A protective collar. Yeah, you're limiting your you're limiting your losses for sure, but you're also kneecapping your gains. That's not something that I would do. That's not something I would do. But however, Stephen, my friend, if that works for you, then do that. I'm a big believer of letting your winners run out of control and cutting your losers short. And by doing this particular trade here, you're capping your winners just like you'd be capping your losers. And I don't think that is the best thing to do. Richard, great question here. What are the top 5 trading books I'd recommend? This is an easy question. We're going to end on this one. Number 1, Trend Following by Michael Covell. If you can get the 2004 version, do so. This is the best $10 I ever spent in my life, hands down, full stop, not even close. The 2004 version is half the size of this version, which I think is the 2012 version. And it's such an easier read. Such an easier read. So again, if you can get the 2004 version, get that one. Next. So that's one. Next is the Complete Turtle Traders. This is what we're doing in OVTLYR University, which is teaching people who, a lot of people haven't traded before. And so we're developing OVTLYR University with the beginner's mindset in place, but to take you from beginner to expert following a set of rules, right? Now, Richard Dennis, the person who did the Complete Turtle Trader, both of these were written by Michael Covell, by the way. He basically said, I can teach anybody to be successful. The difference in somebody who's successful and everybody else is having the consistency and discipline to follow a set of rules. Now, as I mentioned at the beginning of this, right? Most of you guys can't do that. It's just a fact. That's normal. If you can have the consistency and discipline to follow a back-tested, proven set of rules, you can have abnormal returns. But you have to understand that every trade has risks associated with it. And if you cannot accept the risk of the trade, you shouldn't be trading it. Period, full stop. I don't have any sympathy for you at all. Next would be Trading in the Zone. This is the Bible for trading psychology, right? If you want to listen to what I'm talking about, read this book and you're going to hear the words from this book coming out of my mouth. One of the things we talk about is not setting expectations on the outcome of any trade, because any trade individually has a random chance of being a winner or a loser, right? Any trade individually can fall into the winning side or the losing side. And this is why I really like this this chart here. We're going to be using this quite a lot, because any trade individually can fall as a winner or a loser. But given enough occurrences, you should have big wins, small wins, break evens, and small losses, right? And it would fit this curve given enough occurrences. And that's the thing I'm trying to get across here, right? Is any one trade can be a winner or a loser, but given enough trades, you should come out ahead, mathematically speaking, right? And of course, no guarantees. So I'm not making any sort of income claims there. So that's 3 books. This one, How I Made $2 Million in the Stock Market by Nicholas Darvis, updated by my friend Steve Burns. Steve Burns was one of my mentors as well. And I love this book so much. It reads so easy. And Nicholas Darvis, who made $2 million in the stock market, was doing this around the world. His literal day job was dancing. Like, he would go on stage and shake his booty, and he made $2 million in the 1950s by trading by telegraph. I've never even seen a telegraph before, but bro made $2 million. Do you know how he did it? It's honestly simpler than you think. Hear me out. He would buy stocks as they're crashing up. It's crazy. And once they stopped going up, he would sell them. Oh my gosh, that's amazing. And he would buy all the stocks in a sector that's working. He would buy all the stocks in that sector, and then he'd just pick them off one by one once they stopped working. And then he would let the winners run as far as they possibly could. And once they stopped running, he wouldn't own them anymore. It's so simple. It's so brilliant. And that is literally the secret to the stock market. Buy stocks as they're crashing up. There you go. That's everything you need to know right there. Final one is New Trader, Rich Trader, also written by Steve Burns. A lot of people think that I'm the new trader in this book because Steve Burns was a mentor of mine. This is a brilliant read. This is my #1 book. If I were to give to anybody on how to trade, it would be this, right? If you've never traded before, or if you have traded for years and you're still not finding success, this is the book to get you started. Okay. So those are my top 5 books. Now listen, if you're ready to save time, make money, and start winning with less risk, click one of these 2 videos and have a fantastic day. We'll talk soon. All right. We're going to reset, and we are going to make a replay episode. So let me hit a music break. And when we come back, we'll be ready to start the next video.
softly dance again. One more trade, one more lie. Discipline fades beneath moonlit sky. You said you weren't in it for the thrill. Now you're chasing highs against your will. Capital's eroding, egos fed. Professional fund manager, that's what you said. Everyone's winning, you couldn't stay away. You thought you'd sit it out, but the market made you play. Temptations dance, you follow the spark. Now where will you get out? Trading in the
Oh, you're still here? What are y'all doing here? No, I was wearing this the whole time. I don't know what you're talking about. I was wearing this the entire time. You guys crazy. You're hallucinating. Okay. We're going to watch a video. And we'll be doing this today and then all next week as well. Just putting some episodes in the bank for the replays for during Thanksgiving. Welcome back. Yeah, exactly. Share my screen. But it is good to see everybody. If you've been here since the very beginning, type a 1 in the chat. You know what? Let's give away something. If you've been here since the very beginning, I want you to type hashtag OVTLYR. And we'll give away something here real quick. I'll give away 2 things. Ask me anything Friday. Hashtag OVTLYR. Look at that. OVTLYR. There we go. Okay. If you've been here from the beginning, put hashtag OVTLYR in the chat. And we're going to give away some fun stuff. Is that okay with you? Let's go to the OVTLYR shop, see a couple of things that we're potentially going to be giving away. Let's see. We've got slingshots. We've got sit and cash and don't F ups. We've got 80 deltas. We got OVTLYR flags and OVTLYR University and monkey hammers. All kinds of cool stuff. All kinds of cool stuff. But you know what? I'm not going to give you all day to type this in. We're going to do 2 back to back. Let me get my my email prepped for April, not my April prepped for email. So April Friday morning giveaway. Okay, so I'll give you 10 more seconds. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. All right. Who is the first one here? Who's our first winner? It's going to be Phil Brancato. Phil Brancato. Congratulations, Phil. All right, Phil Brancato. Let's see what Phil Brancato has won. By the way, if I mispronounce it, I'm sorry. I'm from Texas. I'm doing my best here. I need to go to the giveaway Wheel of Fortune. The merch Wheel of Fortune here. Here we go. Let's see what Phil Brancato has won. Let's see what Phil Brancato has won. Phil Brancato has won. Oh, a grand prize. A sit and cash and don't F up hoodie. Sit and cash and don't F up hoodie. Outstanding. That's like literally the most expensive prize that we have are the hoodies. So congratulations, Phil. All right, let's do one more time. Let's see if we can get a second grand prize for the day. Who's our second grand prize winner going to be? Man Math 01. Man Math 01. All right, Man Math. Man Math 01. Let's see what Man Math 01 has won. Oh, he's won an ad, some watch parts from AliExpress. I don't know if you guys know this, but like one of my hobbies is watches and watchmaking and stuff. In fact, I actually made these watches for myself and my children. We're going camping this weekend, and these are super fun Jurassic Park watches that I custom made from. I basically got the watch, I got the gel inserts. They're called gel inserts, right? And then put special bracelets on it and everything. And I made one for my dad as well. This is probably like $150 worth of watch parts all put together here, but that's so fun. That's so fun. I have mine and my two sons all right here because we're going camping this weekend. I want to make sure everything was all set for them. So I order lots of parts from AliExpress, but let's see what Man Math 01 has won. Man Math. Ooh, an 80 Delta jacket. That's the first jacket we've given away. What does that look like? Hang on. By the way, these jackets are awesome. I love these jackets so much. Look at that. I need to order one of these. Congratulations to Man Math 01 with the first 80 Delta jacket that has been given away. Congratulations. This is going to be Man Math 01. He's going to be leaning. My son Colin, he's in middle school, and he's so funny, right? He's like, Dad, does this make me look tough? You will look very tough with the 80 Delta jacket, just like that, Man Math. Congratulations. All right, let me send those off to April. Thank y'all so much for watching live the whole time. We'll be doing more giveaways this afternoon in the Friday trading room. You know, that's my favorite episode of the week because we give away people who are watching live, we give away for, and for people who have posted in the Share Your Big Wins, we give away as well. So we'll probably give away a couple $100 worth of things this afternoon, and you can be involved and maybe win as well by signing up for OVTLYR.com. It's literally 82 cents a day. Are the jackets the new star price? No, the jacket was $51. The hoodies are still the most expensive. They're over $70 each. Crazy. So anyway, we're gonna watch this. Let me load this in. I'm gonna try it at 1.2 speed. If it's too fast, you guys let me know. It's a 24-minute video, so a little bit longer. And we're already going long today because I'm trying to make a second video. But of course, if this is too fast, just let me know. Dude, I love the backpack. I don't think the backpacks are the most expensive though. That's what I use as my gym bag. Dear Santa, please send me a hoodie. Okay. Let me see. I need a chart. All right. We as traders have to overcome so many things to be successful in our trading psychology. And we're going to watch this video together right now called The Most Dangerous Cognitive Bias. And this is coming from the Veritasium channel. Now, this is a science channel. I actually like this channel quite a lot. I've watched a lot of videos from this channel. It has nearly 20 million subscribers. So I want to learn with you the most dangerous cognitive bias for traders. And then I'll give you my perspective and hopefully help you learn to be a better trader in the process.
Friday, the 17th of July, 1992. Amidst the chaos of the trading floor at Singapore's International Stock Exchange, one of the junior traders makes an expensive mistake. Instead of buying 20 futures contracts for a client, she sold them instead, costing Barings Bank nearly $40,000.
Bro, if the worst thing that happens to a giant bank is they lose $40,000 on a trade, they're doing all right. $40,000 is not that much. You don't need a lot of money you don't need bank money to lose $40,000 in a trade when you happen to do it wrong. I'm just saying that's not a big amount. $4 million, maybe that's different, but come on.
To save her job, her boss, Nick Leeson, a young trader keen to make his mark, decides to hide the loss. He puts it in an obscure error account. That's account 88888. It's used by banks to solve small discrepancies in trades.
Ooh, that's interesting. So I worked in the banking industry for a dozen years. And it's really funny because you would think that these people would be on top of their balance sheets. You would be very wrong. I worked with around 50 credit unions a quarter, sometimes more, sometimes less. So in aggregate, I saw over 10,000 different credit unions. And it was probably 80% of the time, their balance sheets didn't balance. The balance sheets didn't balance. And we always, 80% of the time, had a balancing line item. And it seems like that's exactly where he was trying to hide that at. That's super interesting.
A dangerous move, and it should have been picked up by the central office immediately, but when nobody from Barings notices, he gains confidence, convinced he can win back the loss and get the team out of trouble.
I'm operating
And no one probably noticed because that's super standard.
in the belief that I can get it back. You know, maybe it goes back to the confidence thing. I don't know. I mean, I'm confident I can get it back at that stage.
But Leeson's staggering overconfidence would create a debt of gargantuan proportions, and
Yo, we went from 39,000 to how much?
Leeson's staggering overconfidence would create a debt of gargantuan
39,000 is nothing. To a bank, that's a blip, and that's why he was able to hide it. But then it turned into $1.5 billion within 3 years. Somebody didn't know how to cut their losses. All right, let's keep watching.
proportions and lead to one of the biggest collapses in banking history.
It's easy for me to make the case that overconfidence is the most dangerous of the human biases. Overconfidence gets us into all sorts of trouble. It leads us to take risks, make commitments, enter contests, try things.
That Olympian right there, that was funny. Overconfidence in trading is interesting. And that really happens a lot to people who just come off a win streak, right? They just had 3, 4, this could happen with 2 trades, 2 winning trades in a row. And you think, I'm on fire, baby. Nothing I touch can go down. Everything is up from here. Let's go. Think about all the Lambo. I wonder what color my Lambo for Thursdays will be, because the Lambo on Monday will have to be bright green. And then once you have that overconfidence, you start making trades you never meant to make in the first place. You start taking risks you never wanted to take in the first place. And then all that confidence is not only gone, but you have like sabotaged yourself. And not only have you sabotaged your account, but you've sabotaged your trading psychology as well. Hey, you can't trust yourself.
That will ultimately fail, sometimes in costly, embarrassing, and dangerous ways.
Overconfidence has been implicated in almost every big disaster, from the sinking of the Titanic to the Chernobyl nuclear disaster to the loss of the Space Shuttle Challenger. But overconfidence isn't reserved for just a few reckless individuals. We can all fall victim to it. For example, 93% of us think we are better drivers than the median, which is, of course,
I'm definitely a better driver than my wife. If you're a better driver than your wife, put a number 1 in the chat. Now, my wife would beg to differ, because I just broke one of the mirrors on our car last week, coming out of the garage. But that's beyond the point. That's beyond the point. I'm still a better driver than her.
impossible. The scale of the problem was identified in some now classic research with a set of simple quiz questions. True or false, Australia is wider than the moon?
Oh, I bet they're about the same size.
It looks small on a map, but it's huge.
Are there more or less stars in the Milky Way than trees on Earth?
More stars. More stars.
1 teaspoon of pure olive oil, about 4.5 grams, contains more chemical potential energy than an equivalent 4.5 gram amount of TNT.
I'm going to say true.
Oh, no.
Oh, these are like, he's talking to all kinds of other YouTubers as well. I've recognized several of them.
This feels kind of like a trick question.
The energy density of butter is
I watched a lot of videos with her.
10 times that of lithium batteries, right? I mean, lithium batteries are rubbish. Everyone's going on about them. Just run your car on butter, I say.
True or false, plants are more efficient than the average solar panel at absorbing the sun's energy?
Yeah, they must be. Now, these aren't the exact questions from the original research, more on those later, but the specifics don't really matter. The interesting bit is what they asked next. How confident are you that you are right?
100% confident.
100% confident?
100, yes.
I think it's true. So I've also got to go 90%.
100%. 100%.
100%?
Yeah.
I don't think we actually had any expectations. This was very early on in the research on confidence assessment.
Wait. He was doing research and he had no expectations on the outcome. Sounds like he'd be a successful trader, I'm just saying.
But we didn't really know what we would find.
The results revealed a surprising disparity between how accurate someone thinks they are and how accurate they actually are. When people are 90% certain, they are right only 75% of the time. In fact, we ran our own version of this
60% of the time, it works every time.
online and found an even more extreme discrepancy. We asked the Veritasium community a bunch of science questions and then asked how confident they were in their answer. Our results showed that those who were the most confident, describing themselves as 91 to 100% sure, were only correct 51% of the time. Since the original research, these results
51% of the time, it works every time.
have been replicated again and again in all areas from general knowledge to motor skills. And it affects everyone, even experts.
I have a paper where we analyze the survey of professional forecasters. These are chief economists at various corporations and banks who are invited to forecast the state of the economy on a quarterly basis. We find that they are on average too sure that they know what's going to happen. So they on average say there's something like 53% sure they have correctly predicted what's going to happen to inflation, for instance, and they are right like 23% of the time.
How well what you think you know matches with what you actually know is called your calibration. So if you're perfectly calibrated and say 80% confident, you should be right 80% of the time. But most of us are not well calibrated.
100%.
100%?
Yeah.
There are 200 billion stars in the Milky Way, but there are 3 trillion trees on Earth.
What? Okay, I saw Nate's comment. There's definitely more trees on Earth. It's not even close. I have a hard time believing that, but that's actually pretty great. I'm glad to hear that.
100% confident?
100, yes.
False!
Most of the time, being overconfident isn't a huge issue. But for Nick Leeson, the stakes soon became very high. Leeson's plan to recover his team's loss was to bet
3 Brazilian trees. Hey, by the way, Brandon found us a month ago. Finally, the YouTube algorithms got onto Brandon's phone, waiting for the 5 favorite trading books to come. Outstanding. Possibly an outlier soon. Sitting in cash. I like that. Hey, listen, if you guys think that Brandon should be an outlier, don't listen to me, Brandon. Right? I'm just a random guy on the internet. Tell Brandon in the chat. Tell Brandon in the chat
that the Japanese stock market would go up. So he went long on the top 225 companies in Japan, the Nikkei 225.
Ever since the Japanese asset price bubble peaked 2 years previously, the Nikkei had been dropping from 38,000 to 16,000.
And he was confident the market would soon bottom out and start rising. But it continued to fall. Over the next few weeks, it dropped to a low of 14,000. And the whole time, Nick was betting the wrong way with ever bigger and riskier bets. He would double down, betting double his losses so the next win would bring him back above water.
Ooh, doubling down. That's what Brandon should do, right? He should double down and just do it. Join Outlier. I mean, don't listen to me. Listen to all these incredible outliers here, right? Brandon, it'll be the best decision you ever make. Do it before the price goes up to 83 cents a day, Brandon. I agree with that statement.
This strategy should work when the next win comes along, but the market collapse was unrelenting, and his losses ballooned from $40,000 to around $3 million. In spite of this, Leeson remained confident. And eventually his luck...
Yo, did y'all see that?
In spite of this, Leeson remained confident.
No, I'm saying serial killer vibes right there.
And eventually his luck turned around. In the spring of 1993, the market rebounded up to 20,000, and by the summer, that account was back in credit.
Leeson goes out to celebrate that weekend, drinking and dancing on tables, finally free of the hole he had dug himself into. But on Monday morning, he made another trading error on the futures market, a damaging...
Okay, listen. Trading errors happen. You guys have seen me do it. It is a thing. It is a reality. Trading errors can and do happen. What do you do? In fact, I'm asking you in the chat. Tell me in the chat, what do you do if you have a trading error? If, for example, to this point, let's say you sold an option versus buying an option. What do you do? You get out. Exactly. You close the trade. You just move on. You remove the error. You fix it immediately. Precisely. Right. You reverse it. You don't hold on and hope and pray that it just works out. Right. You just exit and you take the loss and you move on. Close the trade immediately. Get out fast. Yeah, exactly. Because it does happen. Does that mean that you need to hold it? No way. Like Steven says, you wouldn't do it. No, I've done it. I've done it many times. I've done it live on YouTube many, many times. It happens, right? You click the wrong button, whatever, right? MT says, I bought the wrong option and closed it out as soon as I realized it. Yeah, you fix it right away and you move on. That is what a successful trader does. You just acknowledge the fact, whoop, my bad, and then you fix it.
Loss that Leeson didn't want to admit, so he put the loss back into account 88888, confident that if he got out of the previous one, he could do it again. He began making risky trades to try to recover that initial loss, and as the losses mounted in the 5/8 account, it became harder and harder to make new trades to cover the last loss.
By the end of 1993, his losses exceeded $30 million.
Leeson is obviously an extreme example, but this tendency to overestimate our abilities is something we all share. So the question is why?
The obvious explanation that a lot of people default to, that is, we want to feel good about ourselves and pretend like we're well informed, that we enjoy enormous satisfaction from being able to say, I know, or even better, I told you so. And so we pretend to ourselves and others that we know when we don't. That is the motivated, egocentric version of an explanation for excessive faith in our own judgment.
Wow. I'm going to rewind that, even though it's like an extreme close-up, and I'm slightly uncomfortable with how close it is. That is what sabotages so many traders. Let's rewind that with the extreme close-ups. And just listen, because he is right on the money. Right on the money.
The question is why?
The obvious explanation that a lot of people default to, that is, we want to feel good about ourselves and
we want to be right. We don't want to admit being wrong. We just want to be right.
Pretend like we're well informed.
It should go up. Trust me, bro. Right? The CEO is going to get paid so many dollars once SoFi hits $75 a share. Trust me, bro. It has to happen. Don't you understand how this works?
We enjoy enormous satisfaction from being able to say, I know, or even better, I told you so.
Right. It's going down, but it can't go down any further, right? There's no way it can go down any further. It has to go back up. So many people can't admit when they're wrong. And that's normal. Because that's normal, that's why so many people can't be successful in this game. That is the reason why this is the hardest way to make an easy dollar. That's why 90% of traders blow up 90% of their accounts the first 90 days of trading. It's just they can't admit that they're wrong.
And so we pretend to ourselves and others that we know when we don't. That is the motivated, egocentric version of an explanation for excessive faith in our own judgment.
Reichelt had faith in the idea, if nothing else.
But what if it's something more uncomfortable? Stupidity. Franz Reichelt was a tailor with no formal scientific or engineering training, but he was obsessed with solving the problem of aviation safety.
He spent months designing a parachute suit, which repeatedly failed during testing. But he became convinced the issue was that he didn't have enough height for it to work.
So in February 1912, he took it to the Eiffel Tower, and rather than using a dummy to test it, he jumped himself. Tragic, but also really dumb.
I have a point that I'm getting to. Hang on. For those of you who don't know, the second time I blew up my account, not the first time, the second time I blew up my account, I was telling my wife about it, and my wife is brilliant. She was, I don't know if I probably never mentioned this before. By the way, I love to do this in real life. It's so funny. I probably never mentioned this before, but my wife was valedictorian of her high school. She's incredibly smart. And when I told her that I had blown up my account the second time, she looked at me dead in the eyes and said, "Can't you learn to trade with fake money?" And the funny part about it is not only was she absolutely gorgeous and brilliant and correct, but I felt like a complete idiot because it was so obvious right in front of me. Maybe is a new word we can meme on. Maybe I didn't have to learn with real money, just like bro didn't have to jump off the Eiffel Tower with a parachute on his body when he probably could have done it with a dummy, right? With a fake person instead of himself. Kind of like learning to trade with fake money. Yeah. Did I mention that yesterday? I can't believe I've never mentioned that before. No, not at all.
1912, he took it to the Eiffel Tower, and rather than using a dummy to test it, he jumped himself. Tragic, but also really dumb.
Do you recognize this graph?
Like Dunning-Kruger graph.
Are you confident that this is the actual Dunning-Kruger graph?
Not at all. In fact, I think that this is not the Dunning-Kruger graph. I think that this is a bit of a communication trick.
This is what people call the Mount Stupid curve, which will...
Hang on.
Communication trick.
This is...
If you have heard of Mount Stupid, put a number 1 in the chat. If you've not, put a number 2 in the chat. So I'm sure he's going to go into it, right? But this is what happens to a lot of traders. They find a bit of winning in their trades, right? And so type a number 1 if you've heard this, type a number 2 if not. They find a bit of wins and they become so confident. They're like, oh, wow, trading really is this easy. And they climb all the way up Mount Stupid. And then life punches them right in the face because they had no idea what they were getting themselves into. And then the competence, meaning how much they understand, grows over time. And they realize that they knew absolutely nothing. So their confidence falls right off a cliff. Now, I went through this entire thing myself multiple times.
What people call the Mount Stupid curve, which will pop up if you search for the Dunning-Kruger effect into Google Images.
As far as I understand it, it's an effect that says that when you know very little about it, your confidence is high. And as you know more about it, your confidence sinks until you become a master at it.
But I think that the actual result was like a little bit more fuzzy than this.
It was. This graph doesn't actually show the Dunning-Kruger effect. It's just a meme that resonates with a lot of people, and it became conflated with the effect. In their original research, Dunning and Kruger tested people on tasks like grammar, logic, and humor, and then they asked participants to estimate how well they performed. That produced this curve. You can see that those who performed worse had the largest mismatch between their confidence and performance. They were the most overconfident. Those who performed the best were actually slightly underconfident. This suggests that overconfidence may be linked to how much we know. Those who know less think that they know more than they do. But to me, this effect looks a little like a statistical artifact, because while I was doing my PhD, I asked students some physics questions, and I also asked for their confidence in their answers. And when I looked at the results, accuracy spanned the full range from nearly 0% to 100%. But confidence varied over a much narrower range. All the scores were roughly in the middle. This meant that poor performers were the most overconfident, and the highest performers were actually slightly underconfident. This is exactly what Dunning and Kruger found. So maybe overconfidence isn't entirely due to how much we know, but also because most of us express at least kind of middle of the road confidence. But there is another factor at play here, which is how much information our brains are capable of processing. Monday, the 27th of January, 1986. It's 5:45 p.m. at the Kennedy Space Center in Cape Canaveral, and the engineers from Morton Thiokol, who made the Challenger space shuttle's rocket boosters, make an emergency conference call. They've just seen the weather forecast, predicting temperatures overnight will plummet to 25 degrees Fahrenheit, far colder than any previous shuttle launch. They know the rubber O-rings that seal joints in the boosters become less flexible in the cold, but have just a few hours to gather data, create charts, and present their case. Over the next 6 hours, the engineers present 13 charts with data on O-ring temperature, hot gas erosion, joint rotation, and more. But the data is scattered, incomplete, and not synthesized into a clear narrative. They'd never tested below 53 degrees Fahrenheit, so NASA managers were trying simultaneously to track historical O-ring data, erosion patterns, joint dynamics, seal resiliency, pressure differentials, and more. No single chart told the whole story, so overwhelmed by seemingly contradictory data and confident that their rocket boosters were safe, Thiokol management overruled their own engineers and approved the launch. At 11:38 the next morning, 73 seconds after launch, all 7 crew members were killed.
Calibrating your certainty requires thinking of all the ways that you could be wrong. And that's hard for finite fallible agents like us if it means considering everything that we don't know.
How many chunks of novel information you can hold in your head at one time is your short-term memory capacity. In 2008, Hansen, Juslin, and Winman investigated how short-term memory capacity was linked to accuracy and overconfidence. Participants were asked to give ranges for factual questions like the length of a river or the population of a city. People's ranges were consistently too narrow, which effectively meant they were being overconfident. And those who had worse short-term memory were more often wrong and more likely to be overconfident. Another study conducted by Conti in 2023 asked participants to keep sequences of letters in their mind while they judged their own performance. As the memory load increased, confidence estimates became less accurate, even for participants with higher working memory capacities. Together, these studies suggest that assessing your accuracy is a mentally taxing task. So overconfidence isn't necessarily about arrogance. It's your brain working at the limits of what it can track and hold. Because of this, your brain can start using shortcuts. Psychologist Daniel Kahneman describes these mental shortcuts as heuristics that together create systemic errors called cognitive biases. One shortcut we use a lot is substituting hard questions with easier related ones. Researchers have tested this by asking students how happy they were in their life and how many dates they'd had in the last month. Unsurprisingly, these two questions did not correlate. There's a lot more to happiness than matches on Tinder, at least for most people. However, if you switch it around and ask about their dates first, suddenly the correlation jumps to 0.66. Working out how happy you are in your life is a difficult question. You have to consider many things and
I mean, I'm just watching it at this point. That probably has something to do with like, hey, how many winning trades have you had in the last month, right? And that correlates to how happy you are. How many losing trades have you had in the last month correlates to how not happy you are, right? Rephrasing the question. And for traders, that should not be a thing, right? As a trader, I know it sounds crazy, but you should feel as unemotionally impacted by a win as you do a loss. You should have. I know that that's going to rub a lot of people the wrong way. What do you mean, Chris, that I should feel emotionally unimpacted by a loss? Losses hurt so much. And the gains are amazing and I feel so great. There's a level of emotional maturity that you have to reach as a trader where you no longer feel any sort of happiness or despair, any sort of elation or sadness in relation to the outcome of the trade, because the outcome of the trade is random. You had nothing to do with that outcome. All you did was enter into the market and let the market wave take you where the wave was going to go, right? That'd be akin to getting on a boat, going out into the ocean, and you ended up in, let's say you went in the Atlantic Ocean. You ended up either in Ireland or you ended up in New York, right? One of the things is going to happen. Because you know one of the things will happen, are you really that upset when you landed in or you would land on the West Coast? So like Cork, you landed in Cork or Killarney or Tralee or visit Ireland a couple times, trying to think of stuff on the left side, the West Coast. No, probably not. You probably wouldn't be upset landing in Ireland or landing in New York because you knew one of those outcomes was going to happen. You didn't know which, but you were just along on the waves to get to that point. That's not normal. That's not normal.
Balance them all out. So when you're primed with the information about your dating life, you're very likely to substitute that hard question, like how happy am I in my life, with how many dates have I recently had? Overconfidence from misprocessing information like this can be disastrous. So why are our brains wired this way? I mean, you might expect natural selection to have wiped out the confidently incorrect, but there is evidence that overconfidence can actually be advantageous. Overconfidence can massively improve your status. In a scientific version of The Apprentice, scientists in 2012 compared participants' own assessments of their skill with objective measures. They placed them in group tasks to see who was chosen as a leader and whose ideas influenced the group, tracking status over multiple sessions and assessing whether the desire for status led participants to exaggerate their abilities. The results were clear. Overconfident individuals were more likely to lead, assert themselves, and maintain influence, even when their actual abilities were mid. And the evidence certainly shows people react.
This is what people would say about Chris. He's so overconfident, but
even when
his actual abilities are mid. RCP 3 Kids says he read Trading in the Zone, and it really Trading in the Zone to really understand the mental challenges you must overcome. Yeah, that's why it's in my top 5. Yep, I don't care if it's up or down. I can't change that. Exactly. When you come to the point of understanding that you can't change what the outcome will be, all you're doing is following the plan, it changes everything, right? David says, I've not made that transition yet, but you're going to get there, David. You're going to get there. I believe in you, my friend.
Actual abilities were mid, and the evidence certainly shows people react better to confident individuals. Using an fMRI, researchers at the University of Sussex measured brain activity of people after hearing unconfident versus confident advice. And those who listened to the confident advice had increased activity in the ventromedial prefrontal cortex. That's a brain region associated with processing rewards and expected satisfaction. This means that human brains are biologically tuned to be influenced by confident individuals.
So I guess that's why everybody who comes on YouTube and says $75 in this one stock and you'll be able to retire by the end of 2025. Or conversely, we watched a video yesterday by George Gammon, who every other day puts out a video about this is it, this is the stock market crash and here's why, right? And maybe that's why it took YouTube 2,000 videos for me to show up in your feed, because I don't make those sort of predictions. Why? I don't know what's going to happen, just like the other guys have no idea what's going to happen. But maybe because it makes them sound smart, that people gravitate to that. Maybe I should start making more bold predictions. Maybe I should do that. SoFi bros are going to say Chris is a pedestrian. Yeah, I know. I am such a pedestrian because I don't know where SoFi is going to go. But those SoFi bros, they know exactly where it's going to go. Hey, Dan's here. New here, but OVTLYR is really a different psychology. Trading is trusting uncertainty, and that trust is tricky. Yeah, trading is trusting uncertainty, right? It's the randomness of the outcomes that we have no control over, right? But we do build back-tested, proven, data-backed plans that give us a statistical edge in the market. So we don't have to come out and say, $75 in this stock and you'll be a millionaire. Like talking out of our backside, when all we have to do is say, okay, based on the data that we have, given enough occurrences, this should result in a higher likelihood of having profits than having losses. People want to be right. They end up being right to their own detriment. Well said. Well said. By the way, everybody say hi to Dan in the chat since he's new here. What's up, Dan? Good to see you, Dan. I'm glad you're here, my friend. Let's keep going.
Literally feel better when we hear confident people.
But recognizing that dynamic highlights a potentially problematic incentive for anyone who's contending for positions that they want. People who express more confidence in employment interviews or political campaigns, for instance, do earn the confidence of interviewers and potential voters, even if they're being overconfident. They can't actually deliver. They don't actually know the answer, but they can talk a good line to them.
They don't actually know what's going to happen, but they can sure sound confident in saying it's going to go to $75 a share. Buy this one stock and you'll be a millionaire. Or the crash is coming. Sell everything. Go live in a bunker. You don't have to do either of those. You can live with the fact that you have no idea what's going to happen and you don't need to. Now, I remember when I first started trading and Steve Burns and I were having this conversation, and I'll never forget him saying this, right? He's like, you don't have to know what's going to happen in the market. And I'm like, what do you mean? What do you mean, Steve? You're telling me that if I don't know a stock is going to go up, that I should buy it anyway? What? But Steve, I need someone to tell me that they know the stock is going to go up. I'm searching for that bias. I'm searching for that cognitive bias there. You don't have to know. You can take a measured risk to find out. And if it doesn't work, you can cut your loss short. And if it does work, you can let that winner run as far as it can. It can run out of control. And you can make 10, 20, 50 to 1 on the amount of risk that you were taking. Even when you don't know what's going to happen.
Impress others, even if they can't ultimately deliver on those grand assertions. They know the audience will place more faith in them if they express confidence. Well, they should express maximal confidence.
Leeson?
Yes, they express maximal confidence in the 100 times they called the 2 crashes. Exactly.
Knew this and he took advantage of it. While he was secretly racking up huge losses in the infamous 5/8 account, he was publicly posting huge profits, and everyone believed the illusion.
They come in and they don't test any records. So I can't be happier. They didn't test one record.
As Leeson's hidden losses mounted, he requested huge sums from head office to keep doubling down, up to $5 million at a time. Barings management, barely understanding futures and believing in their star trader, they granted his requests and continued to grant future requests.
Every day that I make one of these requests for additional money, I never expect it to come. I expect somebody to say, look, what the hell's going on?
By autumn 1994, the account was nearly $260 million in the red. To mask...
Yo!
1994, the account was nearly $260 million in the red.
Bro went from a $39,000 loss, which to a bank is literally nothing, like nothing. Like they probably spent $39,000 buying lunch for their employees on that day.
To mask this, Leeson began buying.
Hang on.
It was nearly $260 million.
$260 million. Oh, and it gets a lot worse. This is what happens when you let your losses run out of control and you cut your winners short. This is exactly what happens. Good gravy.
In the red. To mask this, Leeson began buying futures from himself, inflating his perceived profits further. At Cymex's 10th anniversary in September, Barings received 2 awards, largely credited to Leeson. In December, he was flown to New York, seemingly responsible for $44 million in Barings turnover that year. Some traders raised doubts that these kinds of profits could be made from the low-risk trading he was supposed to be doing, but management's faith in Leeson's talent was unshakable, and they dismissed these concerns. Barings...
Okay, this is such a brilliant point right here. And I don't know if I have a slide for this. But I remember Mark Minervini saying something like, you can either be right or you can make money. Well, you can't make money if you're not right. You can either be right, meaning you're going to hold something as long as it takes for you to be right. And even if it goes down 90%, you're still holding on because you got to be right. Or you can have a plan to get out if it doesn't work for you, and a plan to hold it as long as it can if it does work for you. You can either be right or you can make money. And they're not always mutually exclusive.
Overconfidence in Leeson and Leeson's overconfidence in himself would be the bank's downfall.
Okay, there you go. That's it right there. I'd rather be rich than right. Yeah, exactly.
The figures are so big it seems like the ultimate confidence trick. But there's a partial explanation for the delusion on both sides. Leeson's and Barings' overconfidence was amplified by the complexity and unpredictability of the market and the trades he was making. It's sort of an issue of feedback. In a controlled environment where there are clear rules and guaranteed outcomes, like in a chess match, there is clear feedback on whether decisions are good or bad. With reliable feedback, professional chess players are able to learn to make better decisions with more accurate confidence. But in a noisy environment where there is rarely consistent or timely consequences for predictions, this feedback is unreliable. Whether our confidence is accurate or misplaced is increasingly hard to judge, even amongst experts. It's especially problematic for political pundits.
This is going to be a landslide. I think Romney's going to win by quite a bit.
So right now we have Hillary's about a 75 or an 80% favorite.
For example, prior to 2024, political analyst Alan Lichtman had accurately predicted...
Oh, have y'all seen this guy? Oh, he had a total meltdown when Trump got reelected. Oh man, I hope he shows it, because this dude absolutely could not accept the fact that he was wrong. Oh man, I hope he comes to this. This was so good.
The winner of 9 of the 10 previous US presidential elections, using his 13 keys to the White House method. Using the same strategy in 2024, he predicted that
Kamala Harris will be a precedent-breaking president.
Look what happened. Is this crazy?
he attributed his miscalculation to the spread of disinformation that misled the electorate. This noisy environment made it difficult to discern key issues like the actual state of the economy. Similarly, the feedback Leeson had received was inconsistent. He was making some bad trades, but he had also won it all back before, and this significantly clouded his judgment, amplifying his overconfidence. By 1995, Leeson's losses were in the hundreds of millions, and Barings had unwittingly sent him $1 billion.
What? Who's in charge of the money where they unknowingly send somebody $1 billion?
For a bank with around $700 million in capital base.
What? The bank is only worth 700 million, yet somehow they sent this dude $1 billion? Bro.
They were legally only allowed to lend around a quarter of that, but no one questioned it. They were all blinded by his apparent success. At this point, his positions were so big, he estimates that he was probably half of the entire Nikkei futures market. So all he could do was buy himself some time and hope that the market went his way. And for a while, it worked. The economy was stable, and he couldn't see anything on the horizon that would change this. But then, disaster struck.
Japan is tonight in a state of mourning and of shock.
On the 17th of January 1995, the Great Hanshin earthquake struck Japan, 20 kilometers from the city of Kobe. With a magnitude of 6.9, it devastated the city, which was one of Japan's key ports. This devastation spread to the stock market. The Nikkei index plunged 1,055 points. Leeson, attempting to double down again, risked...
Hang on. Notice something here. It's already in a downtrend.
Index plunged...
Already in a downtrend. Now, I'm not saying that people were selling off because they knew the earthquake is coming. But things like this don't normally happen when you're crashing from all-time highs. They normally always start with the 10 going under the 20, price going under the 50. Like, this is sideways to downtrend right there. We can all agree to that. And then a big sell-off happened.
1,055 points. Leeson, attempting to double down again, risked even more money. He bet heavily that the Nikkei would make a rapid recovery, but it didn't. And in the end, in today's money, Leeson had lost $2.8 billion. On the 23rd of February, Leeson went on the run. And 3 days later, Barings, one of the oldest and most trusted banks in the world, collapsed. Overconfidence was at least partially to blame for its downfall. Realizing the walls were closing in, Leeson fled to Malaysia and then Thailand. But his escape was short-lived. He was eventually arrested in Germany and extradited to face justice, marking the end of a spectacularly destructive gamble. He was just 28 years old.
Dude, he looked like a hard 28 right there. I thought he'd be like 38.
Now, we don't all bring down banks, but we are all vulnerable to overconfidence. In a complex world with unclear, noisy feedback where our brains are overwhelmed, a set of simplistic biases can take over. And we all too often end up thinking we know more than we do. So what can we actually do about this?
I try to get better at calibrating my confidence judgments by keeping track and keeping score. So when
keeping track and keeping score, right? We talk about that all the time, about how when you have a series of trades, right, whether it's 6 months or 6 years or whatever, right, evaluate those trades and say, okay, what went right in these trades? What went wrong in these trades, right? Winners and losers are going to have things that went right and things that went wrong. What can we learn from the winners that we can apply to the losers to help the losers? What can we apply to the losers that we can help, or apply to the winners to help the winners, right? Find the characteristics of what happened to the losers and the winners, and then work on your plan to develop it and grow it. There you go.
Colleague asks me, how long is it going to take you to get me comments on this paper draft we're working on? I don't promise I'll do it by Friday. I'm much more likely to say something like, I think there's a 60% chance I can get you comments by Friday. They'll often react with a quizzical look or a laugh.
Well, practicing and being aware of our calibration is the obvious way to improve, but so is being intellectually humble.
I think that the best medicine for overconfidence is not so much information as feedback. And I get plenty of that.
Feedback. Yeah, there you go. Feedback from your own data, right? Not some trust me, bro, on the internet. Not some it should go up. Not some $75 this one stock will make you a millionaire. But hey, using the data and the trades that I have, what has happened here? And it needs to be more than 3 trades, people. Come on. You need at least 50. At least 50. If you can get even more than that, even better.
Though I think people are right that sometimes I do have a little bit of overconfidence.
If we want to become more accurate, we should capitalize on the wisdom of the crowd by listening more to others. In particular, we should listen to people who disagree with us. Understanding the best arguments of your critics, understanding what information those who disagree with you have that you lack, is very helpful for making better decisions.
The best calibrated people aren't those who know the most, it's those who know what they don't know. So true wisdom lies not in being certain, but in knowing the limits of your own certainty. And that's an idea that's inspired our latest project. All those questions
Yeah, we're gonna end it there. I know he's gonna pitch something there, and that's okay. This was interesting, right? This is interesting because we as traders suffer very much from our overconfidence. One of the hardest things to do as a trader is admit you're wrong, right? To take a loss means you have to admit I was wrong. And it means less money in your account than you had yesterday. To take a loss is a very difficult thing to do. However, in order to be successful, you have to cut those losers short and let your winners run so that at the end of the year, at the end of time, you can see your graph look like this, where you have big wins, small wins, break evens, and small losses. Because if you let the big losses come through, you might potentially end up like that banker who blew up $2 billion. And I don't want that to happen to you. Hey, listen, if you're ready to save time, make money, start with less risk, click one of these 2 videos and have a fantastic day. We'll talk soon. It was a good video. I tried my best to relate it to what we're doing. Quick go over the plan today. We got sell signals on the SPY and sell signals on the Qs. So all we have to do is close the trade, right? Unemotionally, this was always the plan. Think about that. This was always the plan, to wait until we got a sell signal. A sell signal happened to be today, so therefore, take it. Not that hard. It's really not that hard. But a lot of people struggle with this. All right. We went super long today. Thank you all so much for coming. Don't forget, this afternoon is our big giveaway Fridays. I love to do that. For the members of OVTLYR, the way to be entered to win is posting in the Share Your Big Wins in our Discord. And you need to watch live. That way you can put hashtag whatever I decide this afternoon. Who knows what it'll be. And then we'll give away all kinds of free stuff. And of course, if you haven't already joined OVTLYR, what are you waiting for? It's 82 cents a day, right? And you're going to get everything you need to be successful, including OVTLYR University. Have a fantastic day, and I will see you this afternoon. We'll talk.
watching. Yeah, we're all outliers too. Grab your coffee, fire up the chart. 10 over 20, that's how we start. No panic trades, no gambler's path. Just like the turtles, we trust the math. Deep in the data, the signal's true. Save time, make money with less risk too. This isn't luck, it's what we do. Following facts, it outlier you. No more FOMO, just process and truth. Follow your plan, stay bulletproof. When the market talks, we listen through. That's what they teach us. Outlier you. Class is in session. Outlier you. Save time, make money. Let's risk too. Follow your plan, no FOMO crew. Start winning together. Outlier you. Every stock is bad till it acts just right. Respect losses, stay in the fight. If it's exciting, you're doing it wrong. Touch some grass, reset, stay strong.